Good afternoon to most of you, and good morning, good evening to some of you. My name is Paul Collins, Chairman of Equiteq, and I'll be your host for this webinar. Thank you all for joining us today. We have over 100 business owners, over 500 business owners registered for this event, so you're in great company. Believe they're actually from about 25 countries around the world, so it's quite a wide audience today. Well, we're certainly living in interesting times. Apparently when this quote was first used, it was intended as a warning. And there's no doubt for us today that we're living with danger for both our health and our wealth. I hope all of you and your families are staying safe and in good health. But today's about your wealth, and specifically the wealth all of you have been building in your firms. If, like me, your company represents a large percentage of your personal assets, you must ensure that you protect that asset during the coming months. Losing all of that value is a real possibility. And if you were planning to sell this year, then you may have to think again. So this is really important stuff. Sadly, I'm old enough to have seen at least 3 prior recessions whilst running my own business. I was a corporate employee during the '87 crash, didn't make that one whilst I was in business, but I saw 2 recessions whilst running WCI Group, my old consulting and IT service business, that would have looked like many firms on the call today. My last recession was in 2008-9, whilst I was CEO of Equiteq. I founded Equiteq in 2004, and for the past 3 years, I've been chairman, whilst my colleague David Jorgensen and his team have successfully grown Equiteq at 40% each year. We've had some great times and some good times in recent years, but it's also tough for us today, so we can really relate to today's message. We've just actioned a 40% cut in our costs, and that's always painful, however you do it. So I'm talking to you today because I've been through this quite a few times before. My first real recession in business was in the early 90s, and frankly, we were caught in the headlights back then. We came within days of going bust, and it took me nearly 5 years to pay back the debts we racked up. We'd only ever seen growth, and that was a problem. We were slow to react. We didn't cut early enough. By the time we woke up and reduced costs and changed our services to what the market actually needed at that point in time, we'd lost an awful lot of money. So why are we running this webinar today? For those of you who know us, you know we're owners and we're partners of knowledge economy firms to grow, acquire and realize equity value. We describe the knowledge economy as being made up as consulting firms, IT service firms, software firms, many other organizations, but mainly they're made up of people that have got people delivering time, people delivering intellectual property to their client base. There's no doubt we're in a great period of uncertainty at the moment, and frankly, worst case, we could be at the start of one of the worst recessions since the Great Depression of the 30s. We went out and did a litmus test of our client base, and that suggested that sales pipelines have been dramatically declining over the last few weeks, and we thought it would be good to try and get this message out as fast as we possibly could. For those of you who are building a firm to sell, reducing your profits to less than last year will probably reset the timetable to sell your firm. We'll talk more about this as we go through the next hour. For all of you who might struggle through the coming months, maintaining sales and profits and thus cash flow will be absolutely crucial to survival. And as I say, I've been there before and nearly came a cropper on that first recession. I know what it's like to get very close to those last few pounds, and you really don't want to get that bad. So this webinar is all about helping you to survive in the coming months, right? As well as making sure that you remain investable from a buyer's perspective when the market inevitably does resume, which it will do. Quite when is anybody's guess at this point in time, but it will come back. This webinar is based around our new tips guide. We call it 100 tips for consulting firms to survive and grow in a recession. Those of you who know us will know that we produce these every now and then. We've done so for the past 15 years. And this one in particular is focused on some of the short-term actions that you might need to take in order to get through the coming months. I hope not years, but through the coming months, right? So you'll be able to download this when you get to the end of this webinar. It's a great guide. It covers an awful lot more detail than we're able to go through over the next half an hour or so. So please download it once we get to the end of the webinar. just a couple of slides about us. I can see from the list of people who've joined that many of you already know us, right? But for those of you who don't, we're in the world of M&A advisory, strategic advisory. We advise people in what we call the knowledge economy. I've mentioned that already. We're somewhat different from our competitors. We take a very long-term engagement model view of life. Majority of our clients, we're helping them prepare for a future transaction. Where the majority of the money and the fees are made is when we actually act for companies in a transaction. Historically, the majority of those transactions have been where we've acted on the sell side, although increasingly these days, and particularly at this point in time, we're doing a lot more buy-side work, and we'll talk more about that as we carry on. So we're about helping companies grow equity value, and then we act for them in realizing that value. We're based across 6 offices, some 50 employees, 4 continents, and the market's an extremely international one. We're very well placed to serve this marketplace. We've got very good buyer relationships, so we take the view that we want to understand what buyers are looking for at any point in time, and that helps us find the right companies to act for. We've got huge industry experience now. We've assessed over 1,000 clients in the knowledge economy. We've advised over 500 on growing equity value, and over 15 years now working in this sector. We've completed just over 100 deals across the marketplace. And on the next slide, you can look at this in more detail on the website, right? But these are just some of the deals that we've been involved in recent times. Over 60% of them now have been cross-border, so going across country borders, and it's getting almost 50-50 now, where private equity or financial investors have been involved as compared with trade buyers. So quite a broad spread of buyer community. So enough about us. Let's talk a little bit about valuation for a second. We've had, right from the start of Equiteq, our own proprietary model of valuation that we turned into a particular piece of software. We call it the Equity Growth Accelerator. And it's based around 4 modules. We arrive at valuation by looking at 4 different things. And we talk about it being driven by profit growth, by risk, by market demand and synergy. And it's worthwhile looking at each of these 4 boxes before we move on, because they're all relevant to the current situation and how the recession is affecting all of us. So it starts up, not surprisingly, at your ability, both historically, currently, and from a forecast point of view, to be able to generate profits. EBIT or EBITDA is the point in the P&L that we tend to focus on. That's the closest possible to that we can get in the P&L to the ability of your firms to generate cash. And of course, from an investor's viewpoint, it's your ability to generate free cash, which is of importance to them. So your ability going forward to continue to be able to make profits and generate cash obviously has a big impact on valuation. When we look at this ability to generate profits, we look over typically a 6-year period, and some of that's going backwards, which is actual. Some of it is current, but we obviously do go out and look into the future, because if a buyer or investor is going to make a return on their investment in your firm, then they're somewhat more interested in the future than they are the past. And so, asking the question, will profit growth continue into the future, is really important for a buyer to understand. And when you've had a graph of your profits over the last few years, which might have been a straight line increasing year on year, it might be easy to extrapolate what it's going to look like in the future. Of course, the environment we're going into now, it may be that curve is going to start looking different. It may flatten out, it may even decline from previous months and start to go negative relative to last year. And that makes it very difficult for investors to put a valuation on a business. It's not impossible, and it certainly doesn't mean that necessarily your business at this point in time isn't attractive or isn't value to an investor if that has happened. But it does make it more difficult for them to put a fixed valuation on the firm. And of course, that will probably play through into the deal structures that any buyer might want to place on the business at this point in time. but valuations, certainly demand for firms has not dropped away at this point in time. There's still very much interest out there, even though it may have slowed down a little. The third box on this chart is what we call market premium, and it's the current sentiment in the market for doing deals. And all I can tell you is that in the last few weeks, we've had more and more phone calls coming in from the buyer community, who perhaps at long last have seen an opportunity for it to be a buyer's market rather than a seller's market. I mean, I think it's most of you will be aware that in the last few years in particular, then it's been very much a seller's market. It's been not unusual for profit multiples to be in the double digits, almost as a starting point for buyers to get on the table to be of interest to a seller. And yes, some of that might change as we move forward. But there's a difference between attractiveness and valuation. And if your firm historically has been attractive, i.e. it's been in a hot spot, it's been an area where there's much more demand than there is supply, it doesn't mean to say that your business suddenly ceases to be attractive just because your numbers might have either flattened out or started to decline. You're still an attractive business. It just might affect at this point in time the deal structure that you're likely to see. The last box is what we call the synergy premium. And this has to do with how much an individual buyer places value on you as an organization. And of course, if you look at a range of 10 different buyers, then they'll all view you in different ways as to how much synergy they think there is between their operation and your operation. And it may well be that for a particular buyer today, then your business is still as attractive as it ever was before, just because what you've got has a level of uniqueness associated with it. And if in good times, they might be in competition with a significant number of other buyers out there, it could be that they take the opportunity to pounce at this point in time to bring you in there. And that might not mean that price deteriorates. It might mean that instead of getting the majority of your funds up front on a sale that you might have expected in good times, that might be spread over a longer period of time to mitigate some of the risk that potentially a buyer sees in the market today. But attractiveness may well still be there. So we look at all four of these when we're coming up with a valuation. You see on that box too that there's a ring there. We call it our equity growth reel. We call it our equity growth wheel, and you'll be seeing more about that in a second, right, when we look at how that impacts some of the questions you should be asking today. This slide you can see in front of you now is probably going to get an awful lot of use in 2021 and may even get more use towards the end of this year. And this is probably some version of what your sales and maybe profit trajectory is going to look like going forward. What I'm showing here is a situation where hopefully over the last few quarters, and I'm showing here from the beginning of 2019, that you might have seen a steady growth in sales and profits in the organization. And then suddenly as a result of the pandemic and the ensuing recession off the back of that, you might see sales starting to decline. And of course, what you would hope is going to happen is that we'll get through this at some time, and then sales will start to get back to the same trajectory that they were on before. And the real question from a buyer's perspective is at what stage could you draw a vertical line on this chart and it be credible for you to say that you've got back to the same trajectory on sales growth that you had before? I mean, it's a fact, and perhaps not surprising, right, that the majority of companies that sell and sell for decent prices are associated with growth, quarter-on-quarter growth over a long period of time. And when as soon as you start to dip down, of course, it challenges what's going to happen in the future. So if we, on this graph, we were to look at the position somewhere between quarter 2 in 2020 and quarter 3, and you were trying to predict where the next point on the graph might be, it might be difficult to persuade an investor that actually Q4 2020 was on this graph was where the next point was going to be. And of course, you can ask any economist at the moment how long this downturn is going to be. And you get 10 different answers, or maybe even 20 different answers for every 10 people you talk to. So it's very difficult to see how deep this is going to be. Is it a V-shaped curve? Is it a U-shaped curve? Is it, hopefully not an L-shaped curve, right? But at some stage there'll be a point on this graph where it will look like the business has turned around, and it will look like you're going to get back onto the same path. And if you take it that a sales process with a buyer or investor, takes some 6 to 9 months in duration, there ought to be sufficient time, even if you started a discussion today, for you to get to that point where you could see that there's been an upturn again. We all hope that's going to be the case, of course, right? That this is reasonably short-lived. And so at some stage before the end of this year, we should start to see the trajectory is heading back in the right direction. So we'll be no doubt drawing lots of charts like this when we're representing people to investors and buyers in the coming months and years. There's inevitably going to be some dip. Some of you may be fortunate to miss out that, but for the vast majority of us, I think we'll see some sort of dip. So we talk about this 8 levers of equity value. Those who know us will know that this underpins most of our intellectual property that we use to help companies grow equity value over a long period of time prior to being in front of a potential investor or buyer. It's about reducing risk through the eyes of a buyer. It's about driving optimal growth in profits and value, right? So what I want to do now is to look at each of these segments and just put the spin on each of these segments with regards to how you might need to react at this point in time if you are indeed starting to see demand for your services reduce at the moment. So let's take a look at the first one, sales and profit growth. I mean, it probably goes without saying that it's crucial to both survival and revenue growth and valuation in the marketplace. If a buyer pays full price for your firm, then they're only going to achieve a good return on investment if you grow profits and cash flow in their ownership. During a recession, one of the things that becomes even more critical and sensitive is actually measuring all aspects of your ability to drive sales and profits and cash flow. So if historically you've not been very good at that, then this is the time to get somewhat paranoid about much more real-time data, getting data on a weekly basis, even a daily basis in some cases, about how your cash flow is moving. If at the moment you're spending more than the revenues coming in, it doesn't take long in a consulting firm for that to get in such that your bank balance is in the red, right? So it can happen very quickly. I remember, back in the 90s when we faced this situation, it was 2 or 3 months before we got into a difficult situation, and then we were into debt and selling assets that we might not have wanted to have done to recover the problem, and that can all get on top of you very quickly. And I know we're all hearing at the moment, and we've been inundated by this as much as I'm sure you have, with the opportunity to borrow money from the government and various other sources, I'm sure. But at the end of the day, you've still got to pay it back, right? And so if you can avoid, borrowing that money, if you can try and get through this period, all right, by keeping your costs more in line with your revenue line, all right, then you're going to be in a better position beyond the end of this. We talk about what good looks like in terms of gross margin and an EBIT as being 50% gross margin and trying to get EBIT to at least 20%. In a recession, you still need to do the same. There's no reason to slacken off on those targets. And indeed, you can argue during a recession when things are getting so tight that your profit line is there as even more as a buffer against you getting into real trouble. All right, so trying to maintain those types of stats is very important. And all I can say is from several recessions so far, do act early and get tough on your cost base. take a really good look at your cost base and challenge yourself as to whether all of it is necessary. As I mentioned a moment ago when we started, we've been growing incredibly rapidly over the last few years, and that's been great. But inevitably, when you do that, you sometimes bring costs on ahead of the revenue curve, and we did as much of that as anybody else would have done, right? And we've had to normalize that now and take some of those costs out. So do act early. Get tough. This is not a time for holding back. Try as much as you possibly can to keep that cost base in line with where those sales are going, and have as many early indicators of where that sales pipeline is going to as you possibly can. The key here is just not running out of cash, right? And that might sound really obvious, right? But when you start to run out of cash, everything starts to go wrong. You become focused on that rather than focused on driving business in the right direction. And if you can do that by getting others in the organization beyond, perhaps most of you are on the call who are the owners, the founders of the business, who are probably very good at going out there and driving sales in through the door, you need to be more focused on doing that than worrying about the cash, right? So this is the time to make good use of finance directors and the finance departments, and maybe even some of the non-execs in the firms. This is critical, and it's often forgot about. I mean, actually, what our clients were demanding just as little as 2 months ago from all of you is perhaps different than what they're focused on now. So we talk a lot about your unique value proposition, your UVP, and you've got to make sure that it fits the current market environment. And even in really good times, this is something that you have to look at frequently. And ones who have managed to modify this to morph it in line with what the market wants today are the ones that will survive best in a recession. We've seen some really good examples of this already out there, haven't we? With people changing the nature of their business to do things online, to start shipping different materials. I mean, just saw the numbers from Amazon today and how their share prices reacted by reacting, very well to what clients, what customers in their case are requiring from their business, and being in an extremely good position to be able to provide it. Well, you've got to try and put yourself in the shoes of your clients and ask the question, what are they looking for today? And is this something that you can provide them? Is it something that you can morph your services to provide them with something that maybe you didn't do in the past, but you could do today? So I think it's really important that you look at your proposition that you're selling in the marketplace and asking, is it fit for purpose today? The other thing about this is making sure that you're part of the solution to your client's survival rather than just the cost. I mean, historically, we have encouraged our clients to make sure that there's a budget in your clients' P&Ls for your activities. And if that budget just talks about the cost for you, it's very easy for someone in the finance department to strike a line through it when they're looking through their cost base and making a decision to cut costs to get their costs in line with their revenues. If at the same time as having your cost base in their P&L, they also have the benefits that are derived from your activities, it may make them think twice. And so being much more explicit about the benefits that you provide to your clients, going out there and reminding them of the sorts of benefits they're getting from your activities, might make them think twice about striking a line through your company's name when it comes to cost cutting on their behalf. So trying to reinvent your offer as well to provide much shorter ROIs. There's no doubt that ROIs and the perspective of your clients will become much shorter in their view. I mean, talking about 3 and 4 and 5 year return on investments for your activities is probably not going to cut it in today's environment. I'd say that the majority of work that you should do with clients or you're proposing today needs to talk about ROIs of less than a year, and in many cases months, because that tends to be the horizon of people that are in trouble. They're looking for what benefits can they get from you today, tomorrow, not in 5 years' time. And the last point on this, on market proposition, this is not the time to be shy. Promoting your expertise, particularly if you've got new service lines to offer. Make the most of the online resources that we all have at our disposal now to get those new messages out there. Use the likes of LinkedIn and Zoom and everything else to get your messages out there to clients, to make them know that you've got services that are going to help them survive the recession that they're going through as well. Questioning the quality and the nature of your management team may be something that you should be doing all the time. And there's no doubt that when times are good, it's relatively straightforward to do well. I mean, if you are following a market that's on the increase, it's far less sensitive to the quality of your management team than it would be in tough times. When times get tough, it's when the pressure really comes on the nature, the quality, the depth, the breadth of the management team. And financial investors always say that they invest in the management teams first. And clearly, you need to make sure that yours is capable. So taking a good look at your management teams and saying, are they fit for purpose? Are they performing in the current environment? It is something that's really important to do. I've mentioned already that those of you who are the founders of your firms, who are very good at business development, who are maybe today's leaders in the organization, the front of the firm, need to be very visible both inside the organization that you run and also out in your client base. This is not the time to be hiding in the office or hiding behind the screen at home. You need to be out there in front of your people, and as we're doing today, there are lots of means online of being visible to both our clients and our staff, and it's a time now to lead from the front. And if you've got people who can concentrate more on some of the minutiae of the business, and particularly on the cost side of the organisation, this is the time to use them. The senior leaders in the firm should be in front of clients, should be in the front of staff, making sure that all qualms and all worries are managed. Part of doing that is delegating profit targets to others and managing performance, right? I mean, it's clearly something that should be done all the time, but in these recessionary times, it makes it even more important to delegate profit targets down through the organization. So it gives you more time to work on the business and lead from the front. And communicating performance to staff, there might be a feeling at the moment that if sales and profits and cash is going in the wrong direction, that's the time when you ought to cover that information up and not keep it from the organization. It's been my experience that exactly the opposite is the thing to do. That the more you communicate performance and the more people see how they can contribute towards improving that performance, the better off you'll be. And I think most staff enjoy and react positively to management being very transparent in situations like this. There's nothing worse than no news, because everybody will assume the worst. So if there is some bad news to share, make sure you share it, and obviously present the positive message as well. You have to give people hope. People need to understand that this won't last forever. But you do have to tell them the hard news if there is hard news to be told. If you have not historically had good financial advice, either internally from your finance department, assuming it exists, right, or from the outside world, now's the time to get some financial advice, particularly if already it might be getting bad for you from a cash flow point of view. And there are others out there that have been through this before and know how to react. There are many, many ways of mitigating cash flow going in the wrong direction. And the government's been talking about some of those today, the loans, the grants, etc. But there are other ways of doing that by negotiating contracts with people, with suppliers by talking to the banks about what you're doing, and talking to HMRC, rescheduling tax payments, VAT payments. There are many things you can do to make it easier for you to survive within your own cash flow means. So do take advice and listen to others. Clearly, in most of your businesses, like mine, people costs are by far the majority of the cost base. And at this time, you've got to proactively manage that capacity and capability. Maintaining the right quantity and quality of delivery resources is always critical to growth and value. But at a time like this, it's got to be you that's in control of potential losses, and you that ensures that you keep the key staff. You don't want to let that get out of control and let others make the decision for you. And that's particularly the case if you've not been good at communicating what's happening in the organization and how the external market is affecting your business. If people are worrying, the ones who are the most mobile, which will be the ones who are the most valuable to you, are the ones that will leave the fastest. And you need to make sure that that doesn't happen. And you get left with those people that, frankly, if you'd have, taken a hard, long look at your list of people in the organization, they might have been the ones that you would have wanted to leave first. So the message here is about controlling the situation, and making sure it's your decision on who leaves the organization and who stays in the organization. Part of this is, particularly if you've already been through that exercise, is those that are still in the organization, is keeping everybody busy. If there isn't sufficient client work for them to do today, and you've made the decision either through some furloughing that might be applicable to some of you, or by taking maybe salary cuts across the board, right, to protect some of the people in the organization, you may need to find things to do which go beyond what they might normally have been doing in serving clients. And there's a whole host of things, a big list. I've got a big list on my desk already of things that we should have been doing that we haven't had the time to do because of client work. And now's the time to do some of that thing. And if it can be stuff that will contribute towards generating more sales for you, then the more's the better. Right, so those case studies, for example, that haven't been written up for ages, putting referral lists together, going out and doing calls to people that you haven't spoken to for a long time, but were clients in the past, and so there's goodwill there, there's rapport there, and it may well be possible to sell them a project over a Zoom or Teams session, right, rather than building up a relationship with a new client from scratch. So trying to boost morale by keeping everybody busy is really, really important in these times, right? Particularly if client demand has dropped below your capacity. If you do have to cut staff, and that's one of your means of keeping costs in control, then of course there's always the contractor market. If sales do start to pick up, and you want to mitigate potentially the volatility that one might have ahead of us, right? I mean, it's very difficult to say whether we're going to start to see increases in demand, and if we do, whether that's going to be sustained, all right? So you might want to mitigate taking more costs on by tapping into the contractor market. And whilst in normal times, we might be saying to clients, there's a limit to what percentage you might do of that, and it might be down at the sort of 20% level. In times of recession, that you might allow that to go up a little, right? So long as you can do that without sacrificing client quality. Sales and marketing, is all about making sure that prospects are aware of your value and making sure that you're persuasive in winning business, right? Making sure that you stand out from the crowd in an environment where your clients are finding it tough, and following up persistently, maybe more so than you might have done in the past, it is key to making sure that clients continue to come to you rather than go to somebody else who may be offering lower prices, or somebody else who's got a more compelling offer. And there's no doubt that if you can tune your value proposition to what the market's looking for now, you really can take market share in a recession. If your proposition is stronger, if it's more current, then you will take market share. So it's about being agile, being fast, fleet of foot, and trying to take where otherwise you may not have done so. Focusing where you've a right to win, and we use this term a lot in Equiteq. It's where clients probably already know you, where you've maybe delivered work in the past and there's good rapport. It's an awful lot easier to go to an old or existing client and either get more business with them or reopen an old client relationship that perhaps for whatever reason has fallen by the wayside in recent years, than it is to knock on the door figuratively rather than literally perhaps today of a brand new client. The person who already knows you and knows what you're capable of is much more likely to take your services, particularly if you've got something new to offer them that fits their current needs. So I think particularly with the old ones, if you can reinvent or morph your services into something that's new to you and them, then the fact that you already know them should get you over the figurative doorstep, right, and starting some work with them. Everybody's going through the same problem. Your clients are going through the same problems that you are in most cases. There are only a few subsectors of our markets who have been fortunate enough to maybe get through this recession extremely well. But so the majority of them are struggling. And so using the recession as a reason for a sense of urgency and using perhaps these newly invigorated services that you're operating now is a great reason to talk to people. And over the last few weeks, I've probably spoken to more clients than I've done in the previous year. People are at home; they're very happy to chat, and in many cases, you can reestablish an old relationship, and I know that's happening with us as we speak, right? So it can happen to you too. Intellectual property is absolutely key in people businesses and consulting businesses to build value. We spend an awful lot of time trying to extract the key intellectual property in our clients when we're making the case for investors and buyers. It makes the difference between selling bodies and selling a solution to clients, and it also mitigates many risks of losing people in an organization, right? So it's crucial to equity value, and it's certainly crucial to survival in a downturn, because if clients see you as just subcontract staffed, then frankly expect to be cut, because there'll be people out there who will be more than willing to offer your type of bodies, if that's what they see you as, for a much cheaper price. And there'll be individuals out there who've been made redundant from other firms who will be offering themselves at much cheaper prices. So somehow the client needs to see you as different from those subcontract staff. And that has an awful lot to do with your intellectual property, your methods, your software, your enablers, your tools, right, that make you perceived to be different by your client base. So retooling your IP to help clients survive is a good thing to do, right? You could argue that with our tips guide, that's exactly what you're seeing now, right? We're trying to react to what the current situation is in the marketplace, right? And we've retooled some of our intellectual property as well. Don't go overboard though. I mean, in better times, we might spend months coming up with a really good piece of intellectual property that's going to have 5 years worth of lifetime. That's not what we're talking about here. We're talking about coming up with something quickly that meets the current need, that actually, hopefully, may only be there for a few months and may see you through the next few months to a year. And then it might need to be changed again, all right? So, trying to develop this, what we call this minimal viable product, right, that actually, just about suits the needs of today and gets through some traction, gets some discussions going is really important. The other thing is, and it may be obvious this, right, but, make sure that IP is secure. If you have to let people go, they're not going to be happy about it, however well you do it, right? And you want to make sure that that at least if they take a copy of what you use for your intellectual property with clients, that you're left with it, right? I mean, I've heard of disaster stories of people taking that one laptop or that one piece of software with them, and there's nothing left in the business to be able to use, and that's really silly to allow that to happen. So just making sure your IP is secure is a sensible thing to do, particularly at the moment. We talk a lot with our clients under normal circumstances about quality of fee income, and most of that is translated into, can you think of long-term annuity revenues rather than short-term project revenues? Can you take some of your IP and turn it into tools that get embedded into your clients and give you long-term revenues? There are many different ways of getting this increased quality of fee income, which increases the probability of it happening over a long period of time. Rather than consulting projects that may only have a lifetime of a few months in many cases. But in the context of today, it's about de-risking sales and the cash pipeline, all right? So focusing on your strategic clients and maybe linking your fees to benefits in those clients to help them beat the recession, sharing some risk and also sharing the upside, the gains, may be one way of doing that. I was actually talking to one of our clients this morning who almost since they started up had a completely contingent fee proposition. And I was asking them how they were managing through the recession. And I wasn't surprised to hear the answer that they hadn't lost any of their current business because they share in the benefits and they share in the risks with their clients. It creates an incredibly powerful client relationship, and it shows that you're on exactly the same page. Now, it's not for everybody. And it doesn't suit every service line, but where you can do that, and if you feel that even if historically you might not have done it, but you could have done it, this is the time to start thinking about making some of your fees contingent, and that might have the chance of keeping you in there for much longer than perhaps you would otherwise have thought, even when your clients are going through difficulties. The last part of this is just being tough on cash collection. I'm sure most of you, most of the time, have great clients who pay you on time. Many of us work with very large organizations, right? And even in times like this, there should be no reason why they can't pay some of their smaller suppliers on time. And it may well be that you've just got to get tough on that. I suspect if you had to get tough, it wouldn't ruin that relationship for the long term, which is what people often think is the downside of becoming tough on cash collection, because everybody realizes that many of us are going to be in that survival situation, and is it about cash? So just be tough on that. Don't let other people being selfish and myopic be detrimental to your survival. Now, we always say there's no business without clients, and that you should always invest in strategic clients and client relationships. Frankly, long-term client relationships always build equity value. They're the surrogate, if you like, for the lack of 7-year order books that many of us just don't have to lay on the table when an investor looks at your business. If you can demonstrate that you've worked with a client over a long period of time, and it looks pretty likely that you're going to continue to do that, then this is a great way of demonstrating long-term value in the business. And you need to do that even more during a recession. So you've been working for a client for the last 2 or 3 years, and the client finds themselves in a situation where perhaps they have to pull back a little on the work that they're giving to you for a short period of time. You might want to take a view on that. You may want to take a view about deferring income, and even though I know that will cause even more problem from a cash point of view. But if you're able to do that, or even to give them a bit of a holiday that gets deferred to later, then even at worst case, I can remember back in my old WCI days in that consulting firm, we had a very large aerospace client, and we'd won a big project with them that had been going on for 2 years, and they hit a recession. When asked the question, how long did they think it was going to last, they reckoned about 3 or 4 months. And we said, okay, well, we'll keep a team in there. We won't charge you for the period we're there. And when the budget comes back again, would you, return the fees that we're due? And they said yes, they would. And it enabled us to keep that relationship strong when other consulting firms who were similarly in that client didn't do that, and they didn't come back after their recession. So just keeping those relationships strong is really important, whatever you need to do during a recessionary time. Focus efforts on clients where there's existing goodwill. And I've said walk the corridors there, and literally that, obviously that at the moment, in literal terms, that's tough to do. But trying to spread your influence from your current points of contact to other people in the organization, it might not be as easy as being able to walk the corridors. But if you talk to your existing contacts and clients over Teams, Zoom, whatever it is you use for your online discussions, then maybe you can get them to introduce you to other people online that will spread your influence. And particularly if you can find a way of working up the management hierarchy. If today it's maybe some level of middle management rather than the senior board level that have engaged your firm, it makes you very, very fragile in a recessionary time to being cut. So finding a way in a recession to get the right discussion with senior management in the clients you're already in is a really good thing to do. And whilst it's more difficult by not being able to be face to face, it's still possible to do that. If you're not the person who's the most senior person in your firm, maybe this is a time to try and introduce your CEO, your MD to the CEO of the client that you're in, and use that as a reason to get a discussion. So at least they can put a face to the organization. It makes it less likely that you'll have a planner's pen put to your name. So those are the areas of potential improvement, right, associated with the 8 levers wheel. But here's some things that we should be doing on a weekly basis now. So I've talked about them as lead indicators of decline, all right? So if we're starting to see sales pipelines drop, inevitably that's going to eventually fall through into cash flow. And these are some of the things that we should be measuring on a day-to-day, week-by-week basis. Obviously cash in the bank. Banks are very quick to get angry with you if this happens without them knowing why. So constant communication with the bank and the situation you're in is part of the keys to make sure that they're on your side if you do start to get difficulties. Measuring debtor days, making sure that you're not starting to suffer from clients not paying you on time. Looking at book workload in man days and value terms, and particularly a bit lower down there, this pipeline index, looking at the ratio of your book workload to consulting capacity. And obviously, the bigger the ratio, the better there, to see what cover you've got to cover in value terms and in mandate terms, your onboard consulting capacity. Valuation of the sales pipeline. We talk there of good and hot prospects. So different stages in the pipeline, however you manage that with whatever system. Make sure that you've got a real good handle on a daily and weekly basis of how that's progressing. The client I spoke to tomorrow that said that their existing work with existing clients is going very well, and they've lost virtually nothing. I've said that they may find it more difficult to start with new clients, and they're expecting that might start to hit them in the fourth quarter this year, just because of those early discussion with new clients are more difficult to do in the current environment. So having a lead indicator of that you may have a problem in the fourth quarter is good to know, and you may be able to start to take action on that in terms of your cost base, right? If you're expecting that to be a problem in a few months' time. So number and value of outstanding proposals, number of sales conversations are all lead indicators of potential problems in the future. And all I would say is just act as early as you can on those lead indicators and cut costs before you run out of cash. You really don't want to get into a position where you're running out of cash, because it can go wrong very, very quickly if that happens. So the question for you is what will your version of this slide look like? every one of you who's on this call will have a slightly different graph. What we don't know is just how deep this downturn is going to be and for how long it's going to go on for. So if you're starting to see early signs of it going down now, again, my only advice is to assume the worst, right? And to take action as soon as you possibly can. We all want to get back to a situation where, with hindsight, we can draw a graph like this and we can put a big arrow on that dip on the curve and say, pandemic, right? And explain that away. And no doubt when we have to do this in real life, we'll be showing all sorts of other economic indicators and showing that your firm bucked the trend and you did better than what the average firm did out there. We'll get into all of that at some point in the near future. But you've just got to make sure that you do get back onto that growth trajectory. So what we've done to try and help companies beyond today is we've turned our 8 levers model into an online growth diagnostic. We've always run what we call these EGA workshops with companies. They've typically lasted over 1 or 2 days. Clearly, it's very difficult to do that in today's environment. So we've produced a much shorter version of this. We turned those 8 levers into a radar chart. If you've not been involved with us on this before, where we look at a score against each of those levers out of 10. And if you're anywhere in the red area, then that shows it's a problem and an area for improvement. And clearly, we're trying to get the radar chart to come out to be closer to 10 out of 10 on each of those areas. We've got something like about 1,500 versions of charts that look something like this, where on the initial benchmark of companies, it might look like the plot on the left, where there's lots of opportunities for improvement against each of the levers. And we're trying to aim it to get to the one on the right. And just as one simple output from this, the area inside that red plot on the right-hand side there has a direct relationship to your profit multiple on sale. And so this is an actual example of a company that when we first met them, we reckon their valuation was probably somewhere between 3 or 4 times profit. And over the period of a year or so, we improved their multiple to 12 upon sale, right, by working on these 8 levers and dragging them out there. Of course, in the current environment, the questions that we would ask of companies are a balance of long-term value creation and short-term survival. So we've tuned an awful lot of our questions, again, to come in line with what the needs are today. And so our aim with this, of course, is to analyze the current business, see how robust the business is to get through the next few months, right, and then get back onto a value creation curve, plan to make improvements in the organization, execute against that, and get into that continuous improvement on valuation in the company. And if many of you out there are starting to see that sales pipeline dip down, you may not have seen it yet hit your cash in the bank, right? But if the pipeline's dipping down, sure as hell it's going to get there soon, all right? So it's probably time to take action. The EGA we put together now can be delivered over a few hours online. It requires a couple of hours of preparation prior to the workshop. You send us some information, takes probably a couple of hours to put together. We do about half a day's analysis with your management team online to identify risk barriers and opportunities, and then follow up that with conference calls to review action plans and build a set of priorities to maintain and then grow sales and profits, right? We will be inevitably very, very much driven by initially what it takes to survive the next few months, right? We'll focus on that first, and then focus secondly on making sure that your trajectory does end up looking like that slide that we showed earlier, at least the later months, and we get back onto a growth trajectory. We use some very experienced people to do this, who've done this many times before, who've done it, been through recessions in the past. The software we use is something that we give to our clients. So once you've been through this exercise, it's something you can use time and time again yourselves, and maybe occasionally coming back to us to see progress against it. So it's the hundreds of clients that we've taken through this in the past tend to use this as their valuation dashboard that they use at board level on a week by week, month by month basis to make sure that valuation's going in the right direction. And you know, if you take nothing out of this, you know, it's speed of action, you know, is the key issue here. You know, it's going to be essential if you're going to come out, you know, ahead of the game at the other side of this downturn. If you're already running out of cash, then there's probably no time to go through a workshop, etc. We should talk now. We can assess the situation quite quickly and put a plan in place that hopefully will turn you back to liquidity, or maybe even propose alternative routes to avoid going into receivership. We've got lots of forms of investment through either private high net worth individuals or through private equity or bank finance, and contacts in those worlds, right, that we can put you in touch to. And we know thousands, literally thousands of firms, many who today would like to acquire firms that for whatever reason are having financial difficulties, right? So even if you're running out of cash, it doesn't mean to say that you're not attractive to some other buyers that are out there. And I don't just mean either at fire sale prices. If you're working in a hot topic area that's been in short supply, and for whatever reason you found yourself in difficulties, right, then your business is still attractive to the right buyer. And please just don't leave it too late to act. So if you'd like a discussion, there's some names here. We're going to be taking some of the questions now, but you, by all means, pick up the phone to these people, or drop an email. You get all the contact details on the follow-up to this after the webinar as well. So let's take a look at some of the questions. See if I can see them, that is. Okay, I've got the questions now. Here we go. So first one, at what point would someone be interested in acquiring my firm if I've dipped? Okay, just 1 second. If I've dipped but I'm recovering. So this is, I mean, the answer is on many of these, it does depend on the circumstances, right? But a few years ago, we used to say in previous recessions, if you've dipped down, that it might be 2 or 3 years before somebody might be interested. The market's changed completely in the last few years on that point, right? And it's partially because demand for firms has been so much greater than there's been supply. And so I've mentioned this a couple of times. If your business is in a hot topic area where over the last few years there's been more demand than there's been supply, it may be that even today, if you're showing a decline in revenue and profits, that it's still attractive today, and a deal could still be done. It could be that you have to wait until you can demonstrate a turn in the corner, right? So if you think back to that graph with the dip in the middle of it, if you've seen the first upturn in sales, that's going to give more confidence that you're back on the right track. So my guess would be, for most firms, it would be months rather than years to get back into a discussion. For many firms, it could be that there's still attraction now. It really depends, I say, what the area that you're in, the sector you're in, and the service lines that you offer. I can see how to keep our business running with our existing projects and backlog, but how do I sell to new prospects remotely? Well, it's tough, isn't it? And that's why I mentioned the issue earlier of going back to existing companies, or maybe even firms that you've dealt with in the past, right? That you have not been able to work for them in recent times. And if you can do that, yes, that's certainly going to be easier than selling to new prospects. I don't think it's impossible to sell to new prospects remotely, but it certainly is more difficult. The key thing would be to try and attract them to you in the first place. There are many means online these days, like webinars, like thought leadership pieces, like articles that you can place in the right magazines to get people to be interested in taking a call from you. Clearly, it's difficult at this point in time to go and have a physical face-to-face meeting, but that doesn't mean to say that you can't have a call online with a new prospect. And personally, I've done that over the last 2 or 3 weeks, and it's not as easy. It doesn't feel as well, but it's still possible to do. On cutting costs, what's the best strategy to preserve equity value? For example, what areas not to cut? That's a very good question. So, clearly, you need to first be looking at those costs that have no impact to sales and marketing in the short term. All right. So look at some of the overhead cost areas, some of the infrastructure costs, and see if you can find a way of doing without those costs in the short to medium term. If you move up the consulting hierarchy from the more junior resources to the more senior, it's usually the case that the more senior resources are those who are more skilled at doing business development, in either bringing new business into the firm or growing existing clients, or managing large engagements in companies, right? Then you might start to cut from lower down in the organization and go further up. It may well be that there are a set of resources that are absolutely crucial to your ongoing future in developing new business, and you would never want to cut those. You would want to maintain them, and that's where I think you go from cutting heads to potentially cutting salaries and bonuses. Most firms, including our own, have chopped bonuses in recent times right the way across the board. If taking heads out that are not going to impact your future and taking bonuses down doesn't take you far enough, i.e. the recession maybe goes on longer or deeper than we anticipated, then it may well be that you need to start taking salary cuts across the board. And usually, a good way to do that for it to be accepted across the organization is tops down. To start at the top of the organization and work down. Let's take another one, and then we're pretty much overrunning now. There are a lot more questions that have come in. They'll all get answered over the next 2 or 3 days, and they'll all appear on our LinkedIn page at Equiteq. But let me just take one other, and then I'll close it off. Companies are looking to poach people in this current environment. Do you have any advice on holding on to key staff? Yeah, just keep communicating to them and telling them how valuable they are to the future of the company. If you do have to make a headcount cut, it's best to do it once and then be able to go out to the rest of the organization and say, we've done that cut. We're not anticipating making another one. If we do have to take further cost out, right, then it may well be that all of us have to take a salary cut across the board. And frankly, in most of our industry, there won't be many companies who are not doing something like this. And so, yes, I'm sure there's some poaching going on. But if somebody's been with you, if you've got a good relationship, if they are very valuable to the organization, and you give them all of those assurances and make sure that you keep communicating, that should be enough to keep them with you, rather than going somewhere that perhaps is more risky from their point of view. Okay, well, look, I'm going to call a close to it there. Thanks ever so much for listening. I wish you all good luck in trying to get through this recession. I hope you all stay safe from a health perspective for you and your families. Do pick up the phone. Very happy to take any calls of any nature on this. And I say the questions that haven't been answered will end up on the LinkedIn page, the Equiteq LinkedIn page. Thanks for coming on the call. Thanks for listening, and good luck. Bye-bye now.